In every major turning point of global finance, there's often a quiet, unrecorded moment where history seems to unfold on its own. But 1971 was not one of those moments. The world remembers President Nixon on national television announcing a temporary suspension of the dollar's convertibility into gold. It felt like a sudden decision, a necessary response to mounting pressure. We all remember the grainy broadcast, the calm, reassuring tone, and the famous phrase to defend the dollar. But what the world never truly understood is that the most consequential monetary shift of the 20th century was not improvised. It wasn't reactive, and it certainly wasn't an accident. It was the final act of a plan that had been forming in the shadows for years, hidden behind technical policy debates, quiet diplomatic meetings, and balance of payments concerns that were never fully disclosed to the public. If you look closely, the clues were always there. Gold had been flowing out of the United States quietly, steadily, far earlier than most people realized. Foreign central banks were starting to ask questions that the U.S. Treasury really didn't want to answer. The Federal Reserve was caught in a difficult position, trying to balance political pressure with a growing structural weakness in the system. And inside the very institutions charged with protecting the gold window, internal memos began to shift in tone. They went from technical and routine to urgent and tense. Something deep beneath the surface was cracking long before that fateful day in August 1971. But none of this appeared in the newspapers. None of it was mentioned in official speeches. The only people who felt it were the insiders, the ones who truly understood what it would mean to sever the last link between money and metal. The story people believe is simple. The U.S. was forced to act. But the story beneath that one, the one buried in archives and off-the-record conversations, and drafts of policy that never saw congressional review, is entirely different. It reveals a slow, deliberate alignment of incentives, motives, and fears. It shows a world in transition, a monetary order that could no longer support its own weight, and a set of decisions made behind closed doors long before the cameras were ever turned on. It shows a system preparing to rewrite the rules while pretending to defend them. Imagine you are standing in a dimly lit vault where none of the labels match what the public thinks they do. Imagine flipping through files stamped confidential, each page hinting at pressure points that could no longer be controlled. Imagine listening to policymakers speak in calm, measured tones while their private notes reveal a different language altogether: urgency, imbalance, inevitability. That is the world you're about to enter, not the version taught in economics textbooks, but the one that shaped our modern global dollar system without ever asking for permission. Because the truth is this: global finance did not change on August 15, 1971. It changed slowly, quietly, through a series of calculated decisions made by people who understood that the system they were managing could no longer be saved in its original form. And when the moment finally came to tell the world what had already been decided, it wasn't really an announcement, it was a reveal. To understand how we got here, we need to go back to the end of World War II, to a small town in New Hampshire called Bretton Woods. In 1944, delegates from 44 Allied nations gathered to design a new international monetary system. Their goal was to avoid the economic chaos that had led to the Great Depression and the war itself. The result was the Bretton Woods Agreement. At its core was a simple promise: the U.S. dollar would be the world's reserve currency, and its value would be fixed to gold at a rate of $35 per ounce. Other countries would then peg their currencies to the dollar. This system created a sense of stability. For decades, it seemed to work. The world rebuilt, economies grew, and international trade flourished. The dollar was quite literally as good as gold. But this system had a fatal flaw, something an economist named Robert Triffin pointed out in the late 1950s. It became known as the Triffin dilemma. Here's the problem. For the global economy to grow, It needed more dollars to facilitate trade and investment. But the more dollars that were printed and sent abroad, the more potential claims there were against the U.S. gold reserves. The U.S. had to run a trade deficit, sending more dollars out than it brought in to supply the world with liquidity. But by doing so, it was undermining confidence in its ability to actually back all those dollars with gold. It was a paradox. The system required the U.S. to do something that would eventually destroy the system itself. By the 1960s, the cracks were starting to show. Countries like France, led by President Charles de Gaulle, grew skeptical. De Gaulle famously called the dollar's status an exorbitant privilege. He argued that the U.S. was essentially getting a free lunch, printing paper money to buy real goods in companies around the world. So, France began demanding gold for its dollars, and other countries quietly followed suit. The steady trickle of gold leaving U.S. vaults was becoming a stream. Inside the U.S. government, panic was setting in, but it was a quiet, controlled panic. Memos from the Federal Reserve and the Treasury from the mid to late 60s show a growing sense of dread. They tried everything to stop the bleeding. They created a gold pool with European central banks to stabilize the price of gold in the open market. They implemented capital controls and taxes to discourage Americans from investing abroad. They pressured allies like West Germany not to convert their dollars into gold, but these were all just temporary fixes. They were like putting bandages on a deep wound. The fundamental problem, the Triffin dilemma, was still there. The U.S. was financing the Vietnam War and expansive domestic social programs by printing money, further flooding the world with dollars. The number of dollars held overseas soon dwarfed the amount of gold sitting in Fort Knox. The promise was becoming impossible to keep. This is where the secret history really begins. By the late 1960s, key figures in the U.S. government, like Federal Reserve Chairman Arthur Burns and Treasury Secretary John Connally, knew the gold window couldn't hold. They weren't debating asterisk if asterisk it should close, but asterisk how asterisk and asterisk when asterisk. Their public statements were all about defending the dollar and honoring U.S. commitments, but their private discussions were about managing the inevitable collapse. They were looking for the right moment, the right narrative. They needed to make it look like they were forced into action by outside speculators and uncooperative allies, rather than admitting the system they managed was fundamentally broken. This wasn't about saving the dollar's link to gold. It was about saving the dollar's role as the world's primary reserve currency asterisk after asterisk the link to gold was broken. The goal was to transition from a gold-backed dollar system to a pure fiat dollar system without causing a global financial meltdown. The final piece of the puzzle fell into place in the summer of 1971. Britain requested to convert $3 billion into gold. This was the trigger the administration had been waiting for. It was the perfect justification. Nixon convened a secret meeting at Camp David from August 13th to the 15th. The decision had, in essence, already been made years prior, but this was where they finalized the plan and choreographed the announcement. When Nixon went on television on August 15th, he didn't say, "We've been planning this for years because the system was unsustainable." He said he was acting to defend the dollar against speculators. He framed it as a bold, patriotic move to protect the American economy. He called the suspension temporary, a word that gave a false sense of hope that the old system might one day return. Of course, it never did. The world was stunned. The Nixon shock, as it was called, officially ended the Bretton Woods system. But what replaced it was exactly what the planners in Washington had hoped for. The world was now on a U.S. dollar standard, but without the constraint of gold. The dollar remained the world's reserve currency simply because there was no viable alternative. Countries still needed dollars for trade, and they still held their reserves in U.S. Treasury bonds. The exorbitant privilege that de Gaulle had complained about didn't disappear. It became even greater. The U.S. could now run massive deficits and print as much money as it needed to finance them, and the rest of the world would absorb those dollars. The system that was born in 1971 is the system we still live in today. It's a system of floating exchange rates, massive global capital flows, and a dollar that reigns supreme, backed not by gold but by the full faith and credit of the United States and the fact that essential commodities, like oil, are priced in dollars. So when you look back at that grainy black and white footage of Nixon's speech, don't see it as the beginning of a new era. See it for what it was, the final, carefully staged scene of a long-running play. It was the moment when the secret plan was finally revealed to an unsuspecting world. The 1971 shock was not a reaction. It was the conclusion. It was the deliberate, calculated, and ultimately successful effort to ensure that when the old monetary order died, the U.S. dollar would be the one to inherit the throne. And it did. To understand why the 1971 Nixon shock was never a spontaneous event, we have to travel back in time. Not just to the end of World War II, but to the very foundation of the Bretton Woods system, and the hidden cracks that were built into its architecture from the start. When this system was created in 1944, it was hailed as a new financial order designed to bring stability to a world shattered by the Great Depression and war. But beneath the surface of diplomatic optimism, a fundamental contradiction was already brewing. The United States made a solemn promise. It would convert U.S. dollars into gold at a fixed rate of $35 an ounce. The rest of the world, in turn, agreed to treat the dollar as if it were gold itself. On the surface, this cemented America's power. But in reality, it created a hidden imbalance that policymakers were already quietly worrying about. The entire system rested on one critical assumption: that the world would never hold more dollars than the U.S. had gold to back them up. But by the late 1940s, this assumption was already starting to crumble. Through initiatives like the Marshall Plan, massive amounts of dollars flowed into devastated Europe and Japan to fund reconstruction. From a strategic point of view, this was brilliant. It rebuilt allies and expanded American influence. But the cold, hard math of gold didn't care about geopolitics. The more dollars Washington sent abroad, the weaker its promise to redeem them became. By the early 1950s, internal reports were flashing warning signs. The global supply of dollars was growing far faster than America's gold reserves. Even then, policymakers knew the system was living on borrowed time. They couldn't say this out loud, of course. Credibility was the only thing holding the entire structure together. But with every passing year, the imbalance grew worse. The turning point came in 1958 with the liberalization of European currencies. This was celebrated as a major success, but it was also the moment the system's internal time bomb started ticking louder. Once Europe lifted its currency restrictions, foreign central banks were free to exchange their dollars for U.S. gold. The theoretical promise had just become a very real option, and they started to use it. France, under the leadership of Charles de Gaulle, was the most vocal critic. French officials argued that Bretton Woods gave the United States an exorbitant privilege, the power to pay its international debts in a currency only it could print. And they were right. The U.S. was essentially exporting its inflation and importing real goods, while the rest of the world had to soak up the difference. De Gaulle didn't just complain. He sent a clear message by demanding gold for France's dollars. Other European nations followed, though more quietly. Every time a ship loaded with U.S. gold bars left a port to satisfy a foreign claim, the anxiety inside the U.S. government grew. Publicly, officials radiated confidence. Privately, their memos told a story of rising panic. The U.S. gold stock, which stood at over 20,000 tons after the war, was cut in half by the mid-1960s. This wasn't some random market fluctuation. It was the visible symptom of a system rotting from the inside out. By the 1960s, a quiet panic was spreading behind the closed doors of power. The Kennedy and Johnson administrations maintained a calm public facade. But inside the Treasury and the Federal Reserve, the numbers simply weren't adding up. America was funding the Vietnam War, expanding social programs, and letting inflation rise at home all while trying to maintain the fiction that every dollar abroad could be swapped for gold. It was a mathematical impossibility, but admitting it would have triggered a global financial meltdown. The system's survival depended on pretending the rules still worked. In reality, policymakers were already in crisis mode, desperately improvising. In 1961, they created the London Gold Pool, a secret pact between major central banks to sell gold from their own reserves to keep the market price pegged at $35 an ounce. The public had no idea how fragile this arrangement was, how close it came to collapsing time and again as speculators tested their resolve. This wasn't a policy. It was a desperate defense, and by 1968, that defense crumbled. The gold pool collapsed under overwhelming pressure, and the world pretended it was a minor setback. But for those in the know, the writing was on the wall. The gold window itself was next. The late 1960s were a period of quiet unraveling. Foreign central banks were accumulating dollars at a pace that made redemption a fantasy. The U.S. balance of payments deficit was widening. But Washington couldn't raise interest rates or cut spending without risking a recession and massive political backlash. The domestic priorities of the United States had become fundamentally incompatible with its international promise. This was the contradiction no one dared to say aloud. Publicly, they insisted the system was stable. Privately, they drafted memos outlining contingency plans for the inevitable, restricting gold sales, creating new exchange rate systems, and even closing the gold window for good. These weren't doomsday scenarios. They were the logical conclusion of a system stretched beyond its breaking point. France escalated the standoff by sending a warship to New York to collect its gold, a dramatic gesture that signaled a complete loss of trust. Behind the scenes, U.S. policymakers were divided. Some clung to the hope that the system could be saved through international cooperation. Others knew the promise was already broken. The only question left was how to manage the public fallout. These debates didn't happen in press conferences. They happened in classified late-night meetings with handwritten notes and whispered acknowledgments that the monetary world was on the brink. By 1970, it was no longer a question of asterisk if asterisk, but asterisk when asterisk. The crisis had become a countdown. Gold redemptions were surging. Speculation against the dollar was rampant. The United States faced a stark choice: save its domestic economy or honor its international pledge. It couldn't do both. The problem wasn't temporary. It was structural. And a new tone began to appear in internal communications. The debate shifted from asterisk how to save asterisk the system to asterisk how to tell the world asterisk it was over. The strategy had moved from defense to exit. This was the true genesis of the 1971 Nixon shock. It wasn't born from a sudden crisis, but from years of mounting pressure and a contradiction that had been privately acknowledged for decades. In the final months, the process was almost like a choreographed performance. The Treasury was losing what little credibility it had left. The Fed was trapped between fighting inflation at home and preventing collapse abroad. Yet the public story remained one of calm and control. What the world didn't see was that U.S. officials had been drafting the announcement long before President Nixon ever stepped in front of a camera. They ran economic models. They held legal reviews. Advisors workshopped the language, carefully crafting a narrative that would frame the decision not as a default, but as a necessary action to protect the dollar from speculators. The story was ready. They were just waiting for the right moment to release it. When August 1971 arrived, the decision had already been made, the speech already written, the narrative already tested. The real shock wasn't the decision itself. It was how easily the world accepted a monetary rupture that had been brewing for nearly 3 decades. This is the part of the story that really makes it into the history books. It's not about the drama of a single announcement. It's about the slow, agonizing realization within governments worldwide that the system they relied on was broken. It's not about defending the dollar, but about the private admission that the math no longer worked. The world remembers a sudden proclamation from a president. But the real story, hidden in archives and classified documents, is that the 1971 shock was not an emergency measure. It was the final, inevitable act in a long play that had been planned, debated, and rehearsed long before the public ever heard a word. Most people think the story of the dollar changing forever started on August 15, 1971, when President Nixon went on TV and announced the U.S. was closing the gold window. It looked like a moment of crisis, a defensive move to protect America's dwindling gold reserves. But the real story, the one that truly changed the world, didn't happen on that day. It happened months earlier in quiet conversations and private realizations among a small group of policymakers. The public narrative was all about saving the Bretton Woods system, the agreement that had pegged the dollar to gold since World War II. It was about stabilizing the dollar and defending America's honor. But behind closed doors, the conversation had shifted dramatically. The goal was no longer to save the system. It was to figure out what would come next after they let it fall. This wasn't a problem to be solved. It was an opportunity to be seized. For years, the United States had worried about losing control. The world was holding more and more dollars, and if everyone decided to trade them in for gold at once, the U.S. would be bankrupt. But by the late 1960s, officials at the Treasury and the Federal Reserve started to see things differently. They realized Bretton Woods wasn't restraining the world. It was restraining America. The promise to exchange dollars for gold was holding back U.S. ambitions, its spending, and its global power. And then came the big realization, the unspoken truth that changed everything. America didn't need the Bretton Woods system anymore. The rest of the world did. Over the decades, the global economy had become completely dependent on the U.S. dollar. It was the foundation for international trade, banking, and investment. Even countries that complained about America's exorbitant privilege of printing the world's money relied on that constant flow of dollars for their own economic growth and stability. The dollar wasn't just a currency anymore. It had become the very infrastructure of global finance. In that new reality, the link to gold was no longer a source of stability. It was a chain holding America back. The insiders saw that cutting the dollar loose from gold wouldn't weaken U.S. power. In fact, it would amplify it. It would allow the United States to print money without worrying about foreign countries calling its bluff. It could run deficits to fund its ambitions and redefine the entire global financial order to ensure its own dominance for decades to come. But here's the catch. None of this could be said out loud. The world had to believe that America was being forced into this decision, that it was a reluctant defensive measure. If other countries even suspected that the U.S. was planning to pull the plug, they would have rushed to cash in their dollars for gold, creating a chaotic collapse instead of a controlled transition. So, the move had to be framed as a crisis. The U.S. had to look like it was cornered, not like it was making a strategic power play. The people who understood this used very careful language. You wouldn't find a memo titled, "Plan to Dominate Global Finance." Instead, they talked about restoring flexibility, reducing external vulnerability, or modernizing the system. These phrases sounded technical and boring, but they all pointed to the same revolutionary idea. The dollar was about to become something entirely new, unconstrained by any physical commodity. It was about to be backed by nothing but the full faith and credit of the United States. What was once feared as a national humiliation closing the gold window was now seen as an engineered turning point. Instead of desperately trying to keep a promise they couldn't hold, Policymakers started crafting the story that would justify breaking it. They weren't preparing for a collapse. They were preparing for a transition to a new era of American power. This is the part of the story the public never saw. It is the quiet confidence that grew in those back rooms as they realized the world wouldn't punish the U.S. for breaking its promise. The world would simply adapt. It had no other choice. The global system was so deeply built around the dollar that breaking the gold link would weaken the dollar's central role. It would cement it. It would make it permanent. But this grand plan required absolute secrecy. The truth had to be hidden, even from many people within the U.S. government itself. A small core group developed the real strategy while everyone else was told to stick to the public script of defending the old system. This created a deep tension, a secret split between what America was saying and what it was actually doing. So the real twist isn't that the U.S. planned to suspend gold convertibility. The twist is that it was planned under the clever disguise of a crisis. It was designed to look unavoidable so that the world would accept a monetary revolution without putting up a fight. The insiders knew that a controlled collapse was far better than a desperate defense. They understood that the world's practical need for dollars for trade and finance would always be stronger than any theoretical commitment to gold. And most importantly, they knew that once the dollar was freed from its golden anchor, it could never be tied down again. In a single night, the world would shift from a gold-backed order to a credit-backed order. And the nation that issued that credit, the United States, would sit at the very center of this new, powerful system. By the time Nixon stood in front of the cameras, the most important part of the plan was already complete. The real shock wasn't the announcement itself. The real shock had happened months before, when a few key figures realized the world would let them get away with it. The very crisis the U.S. had feared for decades, a global run on its gold, became the perfect excuse to build a new financial architecture with no limits at all. What looked like the end of an era was actually the beginning of American monetary dominance in its most absolute and powerful form. It was a masterpiece of strategic statecraft, a fundamental reordering of global power, all brilliantly packaged as a simple defensive necessity. Most of us have heard about the 1971 Nixon shock when the U.S. dollar was taken off the gold standard. The story usually goes that it was a desperate, last-minute decision to stop a run on America's gold reserves. But the real story, the one hidden in government memos and rarely taught in schools, is far more fascinating. It wasn't a moment of panic. It was the final step in a decade-long process, a convergence of political ambitions, financial realities, and geopolitical power plays that made cutting the dollar's tie to gold not just necessary, but strategically brilliant for the United States. The first piece of the puzzle lies in America's spending habits during the 1960s. The country was fighting a costly war in Vietnam while simultaneously funding the ambitious Great Society programs at home. This 1-2 punch of spending was massive. Between 1965 and 1970, federal spending exploded by nearly 65%. As the government printed more money to pay its bills, inflation took off, soaring from a quiet 1.6% to a worrying 5.8%. This created a fundamental contradiction. Domestic policy demanded more spending and more money creation, but the international gold standard demanded discipline and restraint. You can't have both. Internal Treasury documents from that time show that officials knew this. They understood that to defend the gold peg, they'd have to either slash spending or hike interest rates, both of which were political suicide. The system was cracking under the strain long before the public had any idea. The second layer is found in the numbers of the U.S. balance sheet. Think of it like a national bank account. For decades, the U.S. had been spending more overseas than it was earning, running up a huge deficit. By 1970, foreign countries held over $53 billion U.S. dollars, but America's gold pile to back those dollars had shrunk by half since World War II. The math was simple and scary. The U.S. owed foreigners several times more gold than it actually had in its vaults. This wasn't a secret inside the government. The Federal Reserve was running simulations that showed even a small number of countries asking for their gold back could trigger a complete collapse. We got a preview of this in 1968 when the London gold pool fell apart. This was a group of central banks that had been selling their own gold to keep the price fixed at $35 an ounce. When the pool collapsed, the market price of gold immediately shot up, proving the official price was a fantasy. The writing was on the wall. This brings us to our third mechanism, hardball geopolitics. America's allies, especially France, were getting tired of the arrangement. They saw the Bretton Woods system as a way for the U.S. to print endless paper money to pay for its deficits. And foreign adventures, what French President Charles de Gaulle called an exorbitant privilege. To prove their point, the French started cashing in their dollars for gold, and they weren't quiet about it. Between 1965 and 1967, they redeemed hundreds of millions of dollars worth, draining U.S. reserves. By 1971, the situation was critical. Foreign central banks held about $60 billion in dollar claims, while the U.S. had only about $10 billion in gold. Worse, only a fraction of that was actually available to pay foreign claims. The numbers were undeniable. If even a small group of countries decided to redeem their dollars, the U.S. would be bankrupt in gold terms. The gold window, once a symbol of American strength, was now seen inside Washington as a major vulnerability that other nations could use against them. Now for the fourth layer, the quiet evolution of money itself. While everyone was focused on gold, a new financial world was being born. This was the era of the eurodollar market, a massive offshore pool of U.S. dollars that operated beyond the control of American regulators. This market grew exponentially, from about $10 billion in 1964 to over $40 billion by 1971. What this meant was that a huge amount of dollar creation and lending was happening completely outside the old system. The physical gold in Fort Knox was becoming less and less relevant to the actual amount of dollars circulating in the world. U.S. policymakers were smart. They saw this happening. They understood that the global financial system was naturally moving away from a physical anchor and toward a credit-based system. The gold standard was losing its practical purpose even before it was officially abandoned. The world was simply outgrowing it. The fifth mechanism was human psychology, specifically the fear of inflation. By the late 1960s, rising prices were no longer just an economic data point. They were a political problem that everyone felt. As the value of the dollar eroded at home, people and investors around the world began to doubt it could hold its value against gold. This created a vicious cycle. The more inflation rose, the more people wanted to trade their dollars for gold. This led to more redemptions, which drained U.S. gold reserves, which made people even more nervous about the dollar's stability. It was a feedback loop of declining confidence. The government tried everything to stop it. They had tried the gold pool, they tried capital controls, and they made endless public statements reassuring the world. But none of it worked. The system was breaking down from the inside out because people no longer believed in the promise. This all leads to our sixth and final layer, raw political calculation. Richard Nixon became president in 1969 facing a slowing economy and rising unemployment. He was also looking ahead to his re-election campaign in 1972. The situation presented him with an impossible choice. To defend the dollar and the gold standard, the Federal Reserve needed to raise interest rates and tighten the money supply. But doing so would almost certainly cause a recession, which could cost Nixon the election. The gold standard wasn't just an economic issue anymore. It was a direct threat to his political future. So, behind the scenes, Nixon's advisors started looking for a way out. They didn't call it closing the gold window. They used code words like adjusting the system or enhancing policy, flexibility, but everyone knew what it meant. They were preparing to break the link. By early 1971, the pressure was immense. Gold was flowing out of the United States at an alarming rate. In just the first 6 months, foreign countries were threatening to cash in their dollars for gold, and our reserves were dwindling. Speculators were betting heavily against the dollar. Even our closest allies were getting nervous. Britain, usually a steadfast partner, was openly discussing converting its dollar reserves. Then, in May, a bombshell dropped. West Germany, a major economic power, decided to let its currency, the Deutschmark, float freely. They were tired of absorbing inflationary dollars. This was a clear signal. The post-war financial system, known as Bretton Woods, was breaking down. From May to August, the currency markets went wild. The situation was so unstable that it felt like the whole system could collapse at any moment. The question for U.S. policymakers wasn't asterisk if the gold window would close, but asterisk who would control the story when it did. But beneath this public chaos, a different kind of work was underway. This is where we find the next layer: quiet, meticulous administrative preparation. As early as 1970, long before the public felt the panic, secret committees within the U.S. government were already drafting contingency plans. These plans had boring, innocuous titles, but their content was explosive. They detailed the exact steps for suspending gold convertibility. Legal teams were poring over the Constitution, figuring out if the president even had the authority to make such a move. Economic advisors were running complex models, trying to predict what would happen to the dollar if it was no longer backed by gold. And they came to a stunning conclusion: the dollar could survive. They realized that as long as other countries needed U.S. Treasury bonds for their reserves and used dollars for global trade, cutting the tie to gold wouldn't cause the catastrophic collapse everyone feared. This was a game-changing insight. Suddenly, the gold standard wasn't a necessity. It was a self-imposed constraint. This logic began to spread among senior officials. The conversation slowly shifted from how do we save the gold window to how do we prepare to close it. With the what and how figured out, the administration moved on to the next crucial layer: the communication strategy. They knew the announcement had to be a masterpiece of political theater. It couldn't look like a calculated, strategic choice. It had to look like a swift, decisive response to an emergency. To do that, they needed a villain. International money speculators fit the bill perfectly. They needed a heroic justification, defending the integrity of the U.S. dollar, and most importantly, they needed a framing device that would prevent global panic. That device was a single, powerful word: temporary. When Nixon announced the temporary suspension of gold convertibility, it was pure genius. It sent a message of reassurance to foreign governments, suggesting this was just a brief pause, not a permanent break. But internally, everyone knew the truth. The gold window was never going to reopen. This wasn't an off-the-cuff remark. It was a calculated rhetorical tactic designed to buy time, prevent a diplomatic firestorm, and stop a coordinated retaliation. The public heard a president acting with confidence. Allies heard a promise of stability. But insiders heard the quiet, deliberate end of an era. There's another layer to this story, one that often gets overlooked: the changing structure of the financial markets themselves. Throughout the 1960s, something fundamental had shifted. The U.S. government was increasingly funding itself through short-term debt, issuing more and more treasury bills. At the same time, central banks around the world were buying up these treasury securities like never before. They became the primary asset in their foreign reserves. This created a new kind of dependency. Foreign governments were now more reliant on the health of the U.S. debt market than they were on U.S. gold. The credibility of American debt, not its gold stockpile, had become the true foundation of the global financial system. This meant that closing the gold window wouldn't destroy the balance sheets of foreign central banks. In fact, it would protect them. If a panic had started and everyone tried to convert their dollars to gold at once, it would have created a global financial meltdown. This structural evolution was the final piece of the puzzle. It gave policymakers the assurance they needed that the world was ready for a dollar-centric system, with or without a shiny metal anchor. So when you put all these layers together, the market pressure, the secret planning, the communication strategy, and the evolution of financial markets, you see a unified picture emerge. Keeping the gold window open was no longer serving anyone's interests. Closing it was the only logical way to prevent a chaotic, disorderly collapse of the entire system. And because the dollar was already the world's dominant currency for trade and reserves, backed by the sheer size of the U.S. economy and its geopolitical power, America could make this change on its own terms. But it wasn't really a unilateral decision. It was a move coordinated across government agencies, backed by data, and confirmed by geopolitical analysis. When Nixon addressed the nation on that Sunday evening in 1971, he wasn't announcing a decision made in a panic-filled weekend. He was revealing a conclusion that had been formed over years of internal debate and meticulous planning. The real shock wasn't the announcement itself. The real shock was how smoothly the world accepted it. There was no global panic. Currency markets fluctuated for a bit, but they quickly stabilized. Gold began trading freely, and its price went up, but the financial system didn't implode. And the dollar? It remained the king. The United States actually emerged from this with more monetary flexibility, not less. The absence of a crisis proved what the insiders had suspected all along. The world needed the dollar a lot more than the dollar needed gold. So, the Great Nixon Shock is best understood not as an emergency response, but as a strategic transformation disguised as one. The official story was a defensive narrative, but the evidence from archives, economic data, and policy debates tells a different story. It was a calculated decision to redefine the very nature of global money. The gold window didn't close because America ran out of options. It closed because America, and the world, had already built a financial future on a currency that had outgrown its metallic past. The 1971 Nixon shock, when the U.S. dollar was unpegged from gold, feels like one of those moments. The cameras fade, the gold window shuts, and the story ends. But what if it didn't end? What if, instead of closing a chapter, that decision simply built the house we're all living in today? The United States didn't just suspend gold convertibility. It completely rewired the global monetary order. It set in motion a system built entirely on confidence, on credit, and on political will. A system without a physical anchor, one that rises or falls on the ability of governments and central banks to convince the world that their promise of stability is enough. This was the hidden inheritance of 1971, a world where money is no longer constrained by metal, but by the trust we place in institutions. The unspoken truth is that the very problem that broke the old system, the growing gap between political needs and monetary limits, never actually went away. It just went into hiding. What was once a visible crack in a nation's gold reserves is now a silent tension buried deep within balance sheets, sovereign debt, and the complex plumbing of global finance. It is a tension felt by billions of people who depend on a currency they can't see and a system they don't fully understand. The real warning left behind by the architects of 1971 is unwritten in their official memos or in Nixon's televised speech. It's written in the very structure of the system they created. When any system outgrows its foundation, it must either evolve or it will collapse. Bretton Woods evolved, but the underlying principle remains constant. Any monetary order that depends on credibility can be undone the moment that credibility fractures. The United States understood this when it closed the gold window. They knew that defending a promise they could no longer keep would trigger a crisis far more devastating than simply rewriting the rules of the game. But that same fundamental tension exists today, it's just hidden in different layers. We see it in global debt levels, in the constant demand for safe assets like U.S. Treasuries, and in the way countries still anchor their reserves to the dollar even while they criticize its dominance. We now live with a system that has no objective anchor and no mathematical limit. It works because people believe it works. It endures because breaking it would be catastrophic for everyone. And it expands because, frankly, there is nothing to stop it from expanding except for the quiet stress signals that policymakers never fully admit until they can no longer be denied. The deeper insight from 1971 is that major financial transitions happen long before anyone makes a public announcement. The public sees the press conference, the political theater, the dramatic headlines. But the insiders, the people in the rooms where decisions are made, they feel the shift years earlier. You can see it in the data, you can read it between the lines of internal memos. You can hear it in the tone of discussions as they drift from confidence to concern and finally to a sense of inevitability. The closure of the gold window didn't begin on that day in August 1971. It began the moment the promises of the Bretton Woods Agreement collided with the hard realities of fiscal policy, global finance, and national interest. The world accepted the change not because they suddenly believed in a new, unproven system. They accepted it because they had no other choice. That same pattern-mounting pressure, followed by denial, then a reluctant acceptance of the inevitable, and finally, a transition, this forms the blueprint for every major monetary turning point in history. And it raises a question the world has not yet had to seriously answer. What happens when the current system reaches its breaking point? The warning is simple. No system built on pure trust is permanent. No reserve currency remains unchallenged forever. No monetary order can survive when the gap between its promises and its reality grows too wide. The United States recognized this gap in 1971 and acted before the world forced its hand. But today, that gap is widening again. You can see it in the debt markets, in global liquidity strains, in geopolitical fractures, and in the quiet divergence between what the dollar represents and what the world increasingly demands from it. A future shock, if and when it comes, will likely follow the same hidden pattern as the one from 1971. It will begin with years of unspoken tension, private debates behind closed doors, and missed signals. And then, finally, a moment will arrive when the narrative suddenly shifts and a new order emerges, presented not as a choice, but as a necessity. As we look at the world today, remember this. Massive financial systems don't collapse suddenly in a fiery explosion. They dissolve quietly, in meetings with no transcripts, in decisions framed as temporary fixes, and in policies justified as purely defensive measures. The world rarely sees the break until long after it has already happened. Somewhere right now, the debates that will shape the next monetary transformation are already beginning, happening in rooms the public will never enter and in conversations we'll never hear. So if you really want to understand the future of money, don't just watch the official announcements and the nightly news. Watch the silences. Watch what isn't being said. Because that's where the real story is being written,